Since the GFC, the economic conditions in Australia have been the envy of the Western world. However, law firm managements are realistic about the tough climate ahead. In our latest global paper on the legal sector, we explore the state of the market in more than 30 key cities and what this means for law firms who have representation in these. There is a general sense among major law firms operating in Australia that they have topped out in terms of overall size. In other words, the large firms are not anticipating future growth in numbers. In fact, several have trimmed staff numbers in the last 3 years. Some of the factors influencing this include a strong desire to maintain profitability for the existing partners and, in the mid and top tier firms, a focus on making the size and structure attractive for mergers with international firms. Few of the large firms will appear in the market for office premises over the next period, as most will have either a number of years to run on their current leases or else have yet to take up space in new developments which they have committed to over the last 3 years. The traditional focus on prime locations and trophy buildings will remain for the large firms, but there will be an increasing emphasis on workplace productivity and space efficiency. Lease expiries remain a key driver of real estate activity, acting as catalysts for change and analysis of real estate strategy. Changing workplace ratios and the drive for increased productivity are challenging the legal profession to consider a range of more collaborative environments than the traditional legal office. In Sydney and Melbourne, 2016 is a year of reasonably significant lease expiries, leading to potential increased competition for space. Brisbane currently shows a peak in 2017, with approximately 25,000 square metres of expiries in the legal sector.
Sydney rents reflect a two-tiered structure where existing Grade A stock is relatively plentiful, with several opportunities for tenants of up to 10,000 square metres at a discount to replacement cost. Current rentals in Sydney for premium grade properties range from $900 to $1,300 a square metre, with incentives of around 25% of the gross face rent. Grade A rentals sit in the range of $600 to $1,000 a square metre, with incentives of up to 30% of the gross face rent. We believe the Sydney market will favour the tenant for the next 2 to 3 years before moving to a more balanced market. The Melbourne property market has become relatively subdued in recent months, with economic sentiment reflected in a general slowdown in transactions in the market. This change in the market dynamic, coupled with recently committed developments adding to the supply of office stock, and an increase in organisations streamlining and consolidating office space, has led to market conditions favouring tenants. This time last year, predictions were for the market to shift towards landlord favourable conditions in 2013. However, we believe that the market will either be in balance or favour the tenant until 2016. Demand in Brisbane has been very strong until the recent slowdown in commodity prices. This has seen tenant demand noticeably subdued, and we expect incentives to rise in response to this lack of demand. Moving forward, there's 3 large towers mooted for the market. If none of them get out of the ground, when demand rebounds, there will be a stock shortage. If one tower gets out of the ground, equilibrium will be maintained, and if 2 or more get out of the ground, the market will remain tenant favourable for several years. If you look around the globe, whilst there are variances between regions, countries and cities, there is a common theme of a tougher operating environment, yet a real estate cycle that favours law firms to use their leverage now before a more sustained recovery takes place. In Hong Kong, for example, rents are high, but have softened in recent months. Forecasts predict further short-term decline, but overall growth in 2013. Firms would be prudent to position themselves in the market in Q4 12 or Q1 13, where possible, to capture what is likely to be a short-term bottom of the rental market. We invite you to read through our report and understand the different dynamics operating in the more than 30 markets we have covered.